everyone. Thank you for being here today. I'm Vrinda, and I'm a fifth-year PhD student in finance. And today I'll be presenting pension funds, deluge firms, and rise of private markets. So when we think about pension funds, here I'm referring to public pension funds. Think about CalPERS or New York teachers or New York State retirees. These plans are offered by the state and local governments. And what we see is that they have increased investments in private equity over time. So in about 2001, their average allocation to private equity was 3%. And now in 2020, it's about 9% here. And this is visible across the pension funds, right? So here, if you see on the x-axis, I have different state and local pension funds. And on the y-axis, I have the private equity allocation as of December 2020. And here, when you see the size of the bubble corresponds to the size of the pension. And so from left to right, I'm actually moving from like the bigger pensions to smaller pensions. So what I want you to take away from this is that pension funds are increasingly allocating to private equity, and this is the case across public pensions in the US. While at the same time, what we see is that financing for firms via the non-bank sector, and here I refer to non-bank as private equity, mainly has increased. And so what I want to address is what implications this has for the real economy, right? So what one would ideally expect is that the source of capital shouldn't matter. Like it shouldn't matter for the firms whether they're getting funding from a pension fund or an insurance company. But what I show is that that's not the case. So why do we care about this? They're basically significant assets under management in private markets, and public pensions are holders of household wealth in the US, and they're major contributors to this private market. And in principle, public pensions can take on more risk because currently they are 1% under allocated in private markets. And also in the US, the firms which are backed by private markets have really risen from about 106% from 2006, and the public companies have decreased since 1996. So what is the question I ask here? I ask, what is the real footprint of this rise in investment demand by public pensions in alternative assets on firm size, profitability, and financial risk, right? So basically what I ask is that why is there a difference in allocation of capital in the first place? And what is driving the difference in firms, which is getting capital from public pension funds versus the other funds? And what I provide is an explanation based on difference in intermediary investing style. So just to give you a quick overview about the methodology, I use very novel microdata, and I want to thank Bernstein Center for this, where I can track investments from the end investor to the end borrower. And I can observe their names, how much they invest, where the funds are going, and I can track the transaction level deals for all the investors in the world from 1970 to today. And using an event study on the firm's first year of getting capital from private markets, I study the effects on the firm's size, leverage, and profitability. So let me give you a brief overview of my main findings. I show that pension funds are increasing the allocation to private equity, which is driven by their underfunded positions and low interest rates. What I also show that pension funds provide patient capital. That means that public pensions receive delayed returns as compared to other investors. And just to give you an idea of what I'm referring to is like here on the x-axis, I have the months since the inception of the fund. And on the y-axis, you can think of this as a return measure. And what I see is the purple line is the returns to public pensions, and the orange is a return to all the other investors. And public pensions receive return later on, right? And so what I also find is that this capital is reliable in the sense that public pensions provide capital later on in the duration of the fund. And hence private equity funds use patient and public and reliable capital to support ex-ante smaller firms. And these firms drastically increase their profitability on the y-axis on the right-hand side and their leverage on the left-hand side. And that's it. To conclude, I use microdata on investments and deals in private markets to study the flow of capital in this opaque and non-transparent market. And I see that public pensions are providers of patient and reliable capital, which is then used by private equity funds to fund smaller firms. And this has implications for changing risk in the economy. Thank you so much.
Thank you, Vrinda, for that wonderful presentation. At this time, we will take any questions that anyone might have from the audience.
Thank you very much for your presentation. So my first question is, so you said that public pension funds can take on more risk, but I don't know, it seems to me that they shouldn't take too much risk, because at least like they are handling people's pensions. So where did this trend coming from? Did they move into private equity? And do you think it's even like excessive in the sense that they're taking too much risk? And then could you tell us a little bit more about, so it's an event study. What's like, I guess the first year, like they get private equity, also a lot of other things happen. So how do you disentangle that?
No, thank you. This is a very important debate. Like, as you mentioned in the chat, this is so extremely important. So public pensions, what I see are increasingly allocating to private equity, and they're reducing the allocation to fixed income. So private equity has gone up, say 10 percentage points, and fixed income has gone down. Their allocation to public equity is still very high. And when I say that in principle, they can take a lot of risk, what I mean by that is that they have to report that target allocation to private equity means what they target to achieve, and also what they're currently allocating. So what I mean is like they're 1% under allocating relative to their target. And I think you're completely right that this is very risky for the economy. And it is very concerning, actually, which is what made me interested in this project as well. Regarding your second question, so I went over that really quickly because of time, but the idea is that I'm taking the first year a firm gets financing from private markets as year 0, and I see 3 years after and 3 years before. There are other papers in the literature, one of them by Olivier, which studies this in the corporate bond market. So basically, this is a similar technique, which I'm borrowing from that literature.